Inflation and interest rates are two important economic indicators that can have a significant impact on the economy. Inflation refers to the rate at which the overall price level of goods and services in an economy is rising. When inflation is high, it means that the purchasing power of money is decreasing, and it takes more money to buy the same goods and services as before. High inflation can be caused by a variety of factors, such as an increase in the cost of raw materials, an increase in the money supply, or an increase in demand for goods and services. Interest rates refer to the cost of borrowing money. When interest rates are high, it becomes more expensive to borrow money, which can slow down economic growth. Conversely, when interest rates are low, it becomes cheaper to borrow money, which can stimulate economic growth. The central bank of a country, such as the Federal Reserve in the United States, can influence interest rates by adjusting the rate at which it lends money to commercial banks. The relationship between inflation and interest rates is complex, but in general, when inflation is high, the central bank will raise interest rates in order to slow down economic growth and reduce inflation. This is because high interest rates make borrowing more expensive and thus reduce demand for goods and services. When inflation is low, the central bank will lower interest rates in order to stimulate economic growth. In summary, inflation and interest rates are two important economic indicators that can have a significant impact on the economy. High inflation can decrease the purchasing power of money, and high interest rates can slow down economic growth, whereas low inflation and low interest rates can stimulate economic growth. Central banks use interest rate as a tool to control inflation.